Welcome to This Explainer. Look, today we're literally stripping away all the noise and the raw emotion to look at the actual data driving the Bitcoin market right now. If you've been staring at the charts lately and just feeling completely uncertain about where the capital is flowing, well, you're in exactly the right place. We are going to map out the reality of this market step by step. All right, let's just jump right in. Here is the absolute ultimate question every single trader and investor is asking themselves right now. In this post-ETF, post-halving consolidation phase, the market kind of feels like a loaded spring, doesn't it? But it's completely unclear which way it's going to snap. So do you buy the dip? Do you short the drift? Or do you just protect your capital and stay flat? Well, let's run the live data through our macro framework to get the answer.
Let's ground ourselves in the data for a second. Right now, Bitcoin is sitting around 65,500 euros. We're seeing a slight 24-hour pullback, basically just navigating a really tight recent range. But if you zoom out slightly, we're looking at a negative 19% one-year return. So what does this actually tell us? Well, it tells us Bitcoin isn't collapsing, but man, is it drifting. There's no massive catalyst for a breakout right now, but equally, there's no major catalyst for a crash.
Now, you've got to look at the broader context here because it's absolutely crucial. Bitcoin market dominance, it's sitting heavy at about 60%. Capital is still showing this massive, undeniable preference for Bitcoin over altcoins. And while that might be fundamentally bearish for the altcoin market, it acts as this huge shield for Bitcoin itself. Taking a blind short position against Bitcoin right now is fundamentally dangerous, simply because the big capital hasn't rotated out of it yet. Section 1. Why shorting is dangerous. Okay, let's tackle the most tempting trap you'll find in a drifting market. It's that assumption that just because an asset is bleeding slowly, you should immediately open a short position. Actually, scratch that. Our first line of defense against that trap is the Relative Strength Index, or RSI. Based on our current sideways price action, Bitcoin's RSI is hovering right in the neutral zone, around 45 to 55. For a solid short setup, we demand clear, parabolic overextension. We literally need an overbought signal. But right now, we're staring at dead neutral. No overbought signal simply means no short trigger. And that brings us to something you absolutely have to respect in these conditions: whipsaw risk. When you short an asset that's just drifting rather than actually trending, you're exposing yourself to violent, totally unpredictable market noise. Without a confirmed edge, like a deeply overbought RSI or some massive structural breakdown, you aren't really trading a trend. You're basically gambling on chop. You're risking severe liquidations on minor, totally meaningless price spikes. The source analysis actually sums up this crucial point perfectly. Quote, "Shorting year is how traders get chopped to death." End quote. It's brutal, but it's reality. The risk-reward ratio is entirely skewed against the shorter right now. You are stepping in front of an asset that still commands 60% market dominance, and you're doing it without the technical exhaustion required to actually push it down. You don't have a clean setup, you just have a whole lot of chop. Section 2. The macro risk reality. So, if the technicals don't support a short, what's going on under the hood with global capital flows? Well, volatility, which we track through the VIX and VVX, is elevated, and that is highly bearish for risk assets. The MOVE index is high, which signals some really intense stress in the bond market. Credit risk, also elevated because high-yield spreads just aren't falling. Furthermore, liquidity, which, let's be real, is the absolute lifeblood of crypto, is actively tightening. The reverse repo facility is rising, the Treasury General Account isn't falling, so there's no fresh cash entering the system. Throw in the Fed shrinking its balance sheet, and we are looking at some severe macro deterioration. Global flows right now are heavily concentrated in mega-cap tech, not in crypto. Which brings us to Section 3, why buying also fails. Human nature is super tricky. You hear that shorting is dangerous, so you naturally assume, buying the dip must be the elite play. But think about the non-negotiable conditions you need to trigger a buy. You need an oversold RSI, falling credit spreads, dropping volatility, and expanding liquidity. And guess what? Literally none of that is happening. The RSI is neutral, liquidity is tightening up, and macro volatility is elevated. Our system requires falling risk to justify buying, but reality is handing us the exact opposite. Section 4. Welcome to the no-trade zone. We've proven that shorting exposes you to those nasty whipsaw liquidations. And we know buying is fundamentally flawed right now because of that contracting liquidity. So this brings us to the definitive verdict. Do not buy, do not short. Just stay flat.
Look, in an industry where people check their crypto portfolios at 3 a.m. and are just totally obsessed with constant action, doing absolutely nothing feels agonizing. But based on today's conditions, staying flat is the absolute optimal move. Both directions right now offer terrible risk-reward. Doing nothing here isn't some lack of conviction, okay? It's calculated capital preservation. We have no overbought RSI to justify a short and absolutely no oversold RSI to justify going long. Volatility is elevated, liquidity is tightening, and all the big capital is flowing into tech, not crypto. Recognizing a stay-flat environment like this is exactly how you protect your portfolio from getting completely chewed up in the noise. Section 5. Waiting for real signals. So what are we actually waiting for then? Well, the strategy becomes calculated patience. We only act on two future realities. A buy signal triggers when the RSI drops below 40, accompanied by falling volatility, dropping credit spreads, and expanding liquidity. On the flip side, a short signal only triggers when the RSI blasts past 70 into a parabolic extension, followed by a drop in Bitcoin dominance. And right now, we have neither of those. We are just floating in the middle. Think of this as your pre-flight checklist. Before you even think about touching the execution button on your exchange, you need these to align. You need the RSI at an absolute extreme, either deeply overbought or deeply oversold. You need macro volatility, the VEX and VVIX, to be actively falling. You need credit risk, the HYOAS, to be dropping, which signals a healthy risk environment. And finally, you absolutely must see liquidity expanding, marked by a falling RRP and a falling TGA. Until this checklist lights up green, your capital stays safely on the sidelines. So, we've laid out the data. We've looked under the hood at the technicals, the dominance, the volatility, and those macro liquidity flows. The math is incredibly clear. We are in a no-trade zone. But knowing the data, that's really only half the battle. The other half is entirely psychological. So I'm going to leave you with this final, critical question to think about. In a market that is literally built on triggering your impulses, are you disciplined enough to do nothing? Master that, and you master the macro risk reality. Thank you so much for joining me on this explainer. Stay disciplined out there.